Hi everyone, I am Karan and welcome to Karan's Gyan, and today I'm going to talk about something that is known as a Little Champs portfolio. And trust me when I tell you, this is going to be a really interesting video for you to watch. This portfolio outlines 16 small cap shares that have a potential to be future multi-baggers. And trust me when I tell you, this portfolio or the shares, the 16 shares in this portfolio are all solid gold industry leaders with extremely low debt and are solid gold. They provide less risk and have a good opportunity to provide extremely high returns. So it has a very good risk to return ratio. Now, talking about the small cap portfolio, I'll be discussing about the returns this portfolio has given. I'll be discussing about its fund manager, who's a very interesting guy, a very intelligent guy, as I must say. I feel he can be the future big bull replacing Mr. Rakesh Jhunjhunwala in the next 20 to 30 years. This guy is Saurav Mukherjee. I'll be talking everything about him. I'll be sharing everything about him. And finally, I'll be talking about the investment strategy Saurav Mukherjee has used in creating this portfolio and how he has picked up these 16 solid gold small cap stocks. Lastly, I'll also be giving you a detailed analysis of each of the shares in the coming few weeks. So all these 16 shares would come up in the future as detailed analysis videos. So stay tuned for that. Now, talking about the returns, let us have a look at Little Champs portfolio. They actually have Marcellus has about 4 PMS services, which is portfolio management services. Let us have a look at Little Champs, which is the small cap portfolio management service that is provided by Marcellus. In 1 month, it has given 18% returns. In 6 months, it has given 13.7% returns. In 1 year, it has given 40.2% returns. If I compare this to the benchmark has only given 15.7% returns. If I see the portfolio's returns since inception, this portfolio actually came up in August of the last year, so about 1 month, 1 year and 1 month, and this portfolio has given 40.7% returns compared to 15.7% returns of the benchmark. Now let us look at the comparison of the small cap portfolio with the benchmark BSE small cap. Now let us have a look at each of the segments. 1 month 18%, 3 months 36%, 6 month 13.7%, and since inception 41.4%. So phenomenal results, phenomenal returns, I must say, beating the benchmark each and every time. And trust me when I tell you, it is extremely hard for portfolio managers to beat benchmark because sheep can't beat benchmark. You have to be a wolf. You need to know what you are doing. Now, talking about the fund manager. So, Saurav Mukherjee is one of my gurus, as I must say. I have read his books to the entirety, and trust me when I tell you, he is a brilliant fund manager, and he has a thinking which is out of the box. He has come up with three really good books: The Unusual Billionaires, Coffee Can Investing, this is my personal favorite, and Gurus of Chaos, where he, basically tells stories about his experience in the stock market and how investors, lose money and how investors become rich billionaires overnight. So all three books are really good. Have a look at these books. In fact, read a short summary or buy these books. They're really good, they're not that expensive, and at the end of the day they'll give you tons of knowledge that'll take you a long way. So Saurav Mukherjee, here's this for you. And talking about how these stocks are picked, so investment strategy is really important. So there are a lot of small cap companies available in the market. So in a universe of more than 1000 companies, the screening first begins with something called forensic accounting screening. It is there to eliminate those companies that are involved in thuggery, those companies that are not genuine, those promoters that are not genuine, and the companies that are least likely to fail because of their accounting policies. So forensic accounting screening very important to differentiate between good companies and bad companies. Next, is a important criteria which is above median on each parameter. So they're looking for top 20% of small cap companies with excellent ROC, which is return on capital employed, and very extremely low net debt thresholds. Then they'll do a research analysis where they'll do an analysis of annual reports, management interviews. So they are involved with a lot of industries, with a lot of professionals, and they get insider views on each and every company from both the clients of the company and to the suppliers of the company. So they do detailed analysis, and lastly, they have a third party channel checks or management meeting. They corroborate with management and get feedbacks from a lot of people regarding how good the company is. And after doing all this due diligence, they come up with 15 little champions. In this case, there are 16 shares. Now, talking about this portfolio management service, like I said, it's not for you and me. It is for those who can invest 50 lakh rupees altogether at once. If I look at the fee structure, they charge 1.5% per annum. Their performance test, now this is a very important criteria. They say they will not charge any performance fee till the first 10% return is achieved per annum. So if they are giving you a 10% return, they won't charge performance fees. But if they give you a 15% return, they'll charge 20% they'll take a 20% profit share on the extra 5% they gave you in those 15% annual returns. So this marks that this company would only take profits from you if they are giving you returns of more than 10%. And trust me when I tell you, in this age, getting a return of 10%, it's like gold. And 10% will double your money in about 6 to 6.5 years. And that's why there's a price tag of minimum investment of 50 lakhs. Now, talking about the shares that they have picked, I said they have picked 16 shares. The first share is Garware Technical Fibers. So Garware Technical Fibers is number one. It's in its industry. It is in the industry of fishing nets, aquaculture, and sports. And moreover, it has extremely strong innovation in the field of aquaculture. It is number one in the industry. It has showed the past revenue growth of 5-year revenue growth, which is compounded annual growth of 6% each year, and this is compounded. Pre-tax ROC of 25%. So what do I mean by return on capital employed? So for example, I have a company, I need to run that company. I'll need some capital that would basically run the day-to-day operations. For example, my capital that runs day-to-day operations is about 1 crore a month, and I get a return of, for example, 1 crore 50 lakh. So my return on capital employed is 50% because I'm earning 50 lakhs on the 1 crore that I employed for the working capital of the company. Now, why is this important? This is important because a lot of companies finance the day-to-day operations. So they'll finance the day-to-day operations for such as 7% a year. And if the return on capital employed is more than 7% a year, that is called a free cash flow, because they are earning free cash just by borrowing money. And in this case, they are having a return on capital employed of 25%, and this is exceptional. This is really good. This shows that, for example, if they borrow money at 7% and their ROC is 25%, so their free cash flow is 18%, and this 18% free cash can be invested back in the company to expand its operations, or can be given out as dividends. So it is a win-win for you as a shareholder to buy shares of companies that have an excellent ROCE. I have talked about ROCE many times. So do your research on finding excellent ROCE companies. Finally is the net debt to equity ratio. And here, if you see a negative debt to equity ratio, that means the company has no debt. It has a lot of cash. And in this case, you are seeing a negative net debt to equity ratio of minus 0.37. It means the company has no debt at all. It has, in fact, more cash available than the debt it has, which is an exemplary figure to see. So Garware is doing really well, 6% annual, 6% year-on-year growth, CAGR, 25% ROC, cash in hand, about net debt is negligible, in fact negative. And GMM Pfaudler, who hasn't heard about GMM Pfaudler? But just so that you know, GMM Pfaudler gives manufactures glass lined equipment basically for pharma companies, and due to the recent growth in pharma because of the coronavirus, GMM Pfaudler has been doing really well. I'll be doing a detailed analysis of each of these companies, don't worry. So I'll do a detailed analysis of GMM Pfaudler also, especially. So I'll be discussing everything about this company, everything in the business. 13% 5-year revenue growth. If I talk about compounded annually, 27% ROCE, and cash in hand a negative 0.3 net debt to equity ratio. Talking about alkyl amines makes aliphatic amines, or basically ammonia derivatives or ammonia related products for both pharma and agro segment. It is the market leader. There's another company called Balaji Amines, but Alkyl Amines is much better than Balaji Amines. It has grown tremendously, 14% revenue growth year on year, compounded 27% ROC, and here the debt is almost negligible, about 0.03 net debt to equity. Talking about Galaxy Surfactants, you must have heard Galaxy Surfactants a lot in the news. It is the leader. It is number one in the industry of oil-based chemicals. It has prominent clients like HUL, Hindustan Unilever Limited, P&G, Procter and Gamble, doing really well. 7% revenue growth compounded annually, 25% ROC, and here the net debt to equity is fairly high, but it is only in comparison to the other shares. Where if I see at the industry average of chemical shares, the net debt to equity is fairly low. Talking about ultramarine pigments, so ultramarine and pigments, they are in globally, this is globally, they are top 3 in the pigment blue that is used for making packaging products, mainly plastic, and the pigment actually strengthens the plastic. 13% compounded annual growth for the past 5 years, 17% ROC, and it has cash in hand, net debt to equity minus 0.1. Amrutanjan Healthcare came up in the video of Mr. Warren Buffett, where I used his investment strategy. Number 2 rank in industry, 12% compounded annual growth for the past 5 years, 28% ROC, and negative net debt to equity of minus 0.66. So a lot of cash in hand. Mold-Tek Packaging is a company which has phenomenal potential in the future. Number 1 rank in industry of packaging. Basically they packaging of rigid plastics. So they make moldable rigid plastic, so it is moldable first and then it becomes rigid. So number 1 market leader in that. 10% 5-year revenue growth compounded annually, 22% ROC, and here net debt seems to be high compared to other shares, but fairly decent if I talk about in the packaging sector. 0.53 net debt to equity. Suprajit Engineering. So Suprajit Engineering is a leading supplier of mechanical cables used a lot in engineering and construction purposes for flyovers, bridges. Number 1 in industry, 19% CAGR for the past 5 years. It has been growing 19% each year, compounded annually for the past 5 years. Imagine the growth it has in the past 5 years. Pre-tax ROC of 20%, net debt to equity of 0.07, so extremely low debt. So now these, the rest 3 shares are in this case are double PAP Automotive, Sterling Tools, and Lumax Industry. These 3 shares are basically in the sector of automobiles. um, PPAP makes plastic parts of cars. It also makes weather strips. Number one in the industry, 7% growth for the past 5 years, compounded annually. 16% return on capital employed and negligible debt of 0.06, which is net debt to equity. Sterling Tools, it makes tools. It is an automotive tool supplier which is second largest in India. 3% growth, which is the lowest growth for the past 5 years compounded annually. Extremely good ROCE of 23% and fairly low debt of 0.12, which is net debt to equity. Talking about Lumax Industry, again an automotive sector. It deals with the lighting of cars, trucks, various vehicles. 6% growth per annum compounded for the past 5 years. 19% ROC, and it has a fairly high debt of 0.57 net debt to equity. V-Mart Retail is actually really far away if I talk about its industry prevalence in its ranking. So negligible, I won't talk about it. 19% year on year growth compounded for the past 5 years. ROC of 27%, and it has cash in hand, negative net debt to equity. La-Opala. So La-Opala is a company that you won't have heard much about, but La-Opala deals with opalware. Opalware comes basically to plates, utensils, different household products. It has been doing fairly well. Number one in its segment. 7% growth for the past 5 years compounded annually. 25% ROCE, and look at this, look at the net debt to equity, negative 0.47. So cash in hand again. Music broadcast, well, it is basically the second largest radio player in India, and it owns a newspaper called Jagran Prakashan, which is a Hindi newspaper with a good fan following. 8% growth compounded annually for the past 5 years. 15% ROC, and excellent cash in hand, a negative net debt to equity of minus 0.35. Next comes DCB Bank. So DCB Bank is the smallest bank out there in the listed space, a market capitalization of 2500 crore, but it has tremendous potential for the future. I would say if you want to pick up a small cap bank, a DCB Bank should be bought. As of now, it is trading at an extremely low discount. It is trading at about 80-85 rupees. It made a high of about 200 rupees. If I talk about the 52-week high, personally, I have got good many shares of DCB Bank. I'm not advocating DCB Bank, but I found DCB Bank good because of its growth. For the past 5 years, it has been growing at 10% compounded annually, ROCE of 11, and DCB Bank, it has been doing fairly well. If I look at small banks, it has got good asset quality. 95% of its loans are well secured. Moreover, its top five loans don't have more than 5 to 10% of its loan book size, so very less exposure to its big loans that has given out. Good share, I would say. It has taken a beating lately, but hold on to it. It might give you excellent returns in the future, but it would give you good returns, that is for sure. But excellent returns, it depends on the market sentiment and the banking sentiment in the future. As of now, these sentiments are a little rocky. Talking about MAS Financial, it is the only NBFC in this portfolio. It has been doing really well, and people say it might be the next Bajaj Financial. Talking about the past 5 years, it has been growing at 11% compounded annually, 25% ROC, and again, I can comment on its net debt to equity well because it's an NBFC. Similarly, with DCB Bank, it is a bank. So, having a look at its net debt to equity is pointless. So, guys, this is my take on the Marcellus Little Champs portfolio. Each of these shares are golden except Lumax Industries. I find each of these shares are worth your investment, but these are small cap shares. Don't forget about the exposure that you need to have in your in your large cap shares. And finally, my suggestion to you is acquire this acquire shares in this portfolio. The only thing is they haven't given out the weightage in each of these shares that they have. So we can't say that you need to acquire more shares of Garware Technical or lesser shares of GMM Pfaudler. But this is pretty much it. This is the information we have got out there. But if you got 50 lakhs with you, I would say invest 50 lakh rupees by giving it to this man who is a genius according to me, Mr. Saurabh Mukherjee. Please do read his books. I'm sure you'll be impressed by all three of these books. Excellent writer, prolific writer, and intelligent man. So guys, again, Marcellus Little Champs portfolio. Have a look at this portfolio and let me know what you think about it. So till then, thank you very much and have a nice day.